Welcome. This is Zach Louis from the events team at SEIA, and thank you for joining today's webinar, How Private Capital is Shaping the Energy Transition. The Solar Energy Industries Association is leading the transformation to a clean energy economy, creating the framework for solar to achieve 30% of U.S. electricity generation by 2030. SEIA works with its 1,000 member companies and other strategic partners to fight for policies that create jobs in every community and shape fair market rules that promote competition and the growth of reliable, low-cost solar power. Founded in 1974, SEIA is a national trade association building a comprehensive vision for the Solar Plus decade through research, education, and advocacy. Thank you for your continued support. If you have any questions or needs, please contact the SEIA membership team by emailing membership@seia.org. Please note that all listeners will be muted during this call. However, participants may submit questions for a Q&A session following the presentation. For the Q&A portion of this webinar, you may type your question to the panelists into the chat box located within the black navigation bar on your screen anytime. We will try to answer as many questions as we can. This webinar is open to press. After this webinar, participants can expect to receive a copy of the recording and link to today's presentation and a follow-up email in the coming days. I'm going to now pass it off to Danielle Patterson and Michael Joyce of Vincent & Elkins to begin today's webinar.
Hi, everyone. Thanks for having us today. I'm Danielle Patterson. I'm a partner at Vincent & Elkins. I focus my practice exclusively in the energy and infrastructure industry. So that's everywhere from oil and gas, midstream to renewables and everything in the energy transition space, which we'll be talking about today. With me is my partner, Michael Joyce, who also focuses broadly across the energy industry and all kinds of methods of financing the energy industry. So today's topic is how private capital is shaping the energy transition. The first place I'd like to start really is, what do we mean by energy transition? I would say, 3, 5, 10 years ago, most of our conversations on this topic were focused more on traditional renewables. Wind and solar power generation. Maybe the buzzword people used was alternative energy. Sometimes you'd hear clean technology. I think today, when we really focus on energy transition, it's best described as a transition to a low carbon neutral environment. I fully recognize we're talking with a solar trade association today. Some of you may be exclusively focused in solar. Some of you may be focused beyond solar. So we're definitely, Michael and I do a lot of transactions in the solar space. We're definitely going to hit on solar, but maybe framing today's presentation for you that are focused exclusively in the solar space, I think there's sort of two takeaways. With the energy transition, there are a lot of areas where private capital is going to be going and focused beyond wind and solar power generation facilities. That's for a variety of reasons that we'll go through today. There's still a lot of money that's needed to continue to be invested in solar power generation facilities, but there will be a competition for capital that is created on the basis that there are other places with the energy transition where private capital could be spending its money. I think the second focus for those really focused in the solar industry are, like I said, in the past, people have been very focused on solar and wind power generation. But if we really are going to electrify everything, if that being one of the potential goals and method forwards for a low carbon environment, we'll need a lot of capital invested in places beyond just the power generation. We need infrastructure, we need transmission lines, we need energy trading companies, we need software and equipment companies. If you think about everything that's needed for electric vehicles, for example, we need the vehicles, the batteries, the charging infrastructure, the manufacturers. So there is a massive opportunity created by the energy transition, and solar is obviously going to play a large piece of that. Moving through the slides now. So just to, I think we can go back to the prior slide. Sorry. So just to hit on this, decarbonization, like I mentioned, is obviously a mega trend. Just to kind of put it into perspective, if we're taking our stated goals from the Paris Climate Agreement, if we're looking to limit global warming to 1.5 degrees Celsius, we will need net zero carbon emissions by 2050, which is really not that far away anymore. I think the dichotomy is that this would require an overhaul of the energy industry. But again, we're talking about an energy transition. It's not something that will happen overnight. And it's going to take individuals, corporations, institutions, governments. It's going to take all players, in the sector to achieve these goals. Private capital cannot achieve the energy transition that we need alone, but it will obviously be a major catalyst through its funding. You can go to the next slide. And we can go to the next slide. All right, and the next one. Okay, so let's just look at some of the numbers here. Depending on the sources that you're looking at, we're being told we need anywhere from 100 to 160 trillion dollars invested in the energy transition by 2050. That's a massive number. And the other thing I'll say is that is investment, not commitments. So obviously huge numbers and goals to achieve there. Let's hit the next slide. And just to put it into perspective with the shale revolution, which, a little over a decade ago was the last major revolution we had in the energy industry, there were somewhere around $900 billion invested worldwide in the shale revolution, 350 billion in the US. Again, we are looking at 150 trillion worldwide to hit our 2050 goals. Michael, I'll pass it over to you if you want to introduce yourself briefly and dig into some more of the numbers.
Certainly. As Danielle mentioned, I spend a lot of my time in the financing, development, and acquisition of primarily renewable energy projects. So when I came to V&E and started hearing more about energy transition, I just thought of it as kind of my day job, which I think many of you in the audience would say as well, having been at solar for quite some time. So we want to switch to the next slide, kind of talk a little bit about what's driving the change. And when I hear the letters ESG, I think back to when I first heard them, 5 or so years ago, and it was effectively then akin to greenwashing. How do we placate folks with making them feel that we are paying heed to environmental concerns? 5 years later, I would no longer say that's the case. These ESG drivers are very real, as evidenced by the recent rulemaking at the SEC level, looking to hold public companies to their climate objectives on a uniform measuring system and a reporting requirement. So it seemed unfathomable just half a decade ago. Now it's a very real thing. And the reason it's real is because the support is coming from all sides. We talk about stakeholders in ESG. It's all of us in terms of the air we're breathing. It's the people in the boardrooms. It's the employees that want to work at companies that are more socially responsible. It's the consumers. So it's in every part of the value chain and every part of the stakeholder chain. You have real driving ESG. How does that effectuate to investment? Well, the private equity funds have looked and done targeted renewable or energy transition funds, in some cases, shockingly, even with lower yields, recognizing, as we're going to discuss, that at least for the more mature, safer assets, which you would certainly count utility scale solar in, the returns are not going to be on par with what they've traditionally seen in private equity fundraisers. So you have massive influx of capital competing, which are driving down yields, frankly, even lower, which aren't consistent with traditional PE goals. So again, the idea that we have green funds or transition funds that are targeting lower returns, really leaning into the investment thesis as to beyond just the making of the money and the opportunity for the money, that there are these other social reasons why it's important for all of us to take stake and invest. And I use that more than just the monetary dollars term. But looking at the dollars, you can see there's been just a massive influx in terms of the amount of capital jumping up drastically just from 2018 to 2019, and even more so year after year. I think this is a little outdated. The numbers that we have show just further growth in this space, which leads to the question of where you're going to put all that capital. Some encouraging news, despite what I said about there being lesser return hurdle rates in those newer funds. Green tech has generally outperformed the broader equity markets. So it's not all, hey, if you want to do this, you've got to just accept lower returns. There is the idea that on par with levelized cost of energy, these investments are penciling their own right, which makes the trade winds behind them all the more powerful. We can go to the next slide, please. So we talked a little bit about what's driving it in terms of the investor stakeholders, which you see up there at the right, and the pressure they're putting. I want to talk a bit more also on the young consumers. I wasn't too long ago, I counted myself among those. It's kind of caught up to me that no longer can I say that. But the way that young people think about where they're investing, not just their money, but their time, what careers they're interested in looking for. I think Danielle and I would both attest to being at VNE, we have almost 100% of our associate base looking to do energy. That's what we do. That's what the firm does well. That's what the firm's done for 100 years. But I think it's not an exaggeration to say that whenever we put out a client alert for a new deal or just a conflicts alert, I've got 2 or 3 junior associates telling me how interested they are in working on that project, how much, if they can't work on that project, they'd like to get a look at the next one. It's something that's near and dear to their hearts. And it's so that, again, the younger generation is certainly focused and appreciating how this impacts them. Otherwise, we now, with the greenwashing accusations I alluded to, you've got a lot of folks focused on kind of how we track this stuff and how we hold folks accountable. Mentioned the SEC, also the various trade groups and metrics companies are looking to track carbon footprint that enables you to really do true testing of where folks are putting their money where their mouth is. We are still, as noted there on the top left, lagging beyond Europe, but the public companies being forced to report will certainly change that. And we already see it in the private fundraising as well. And the fact is that without ESG, there's a negative value proposition, which is to say, if you don't have an answer for the ESG question in terms of what your company is doing, no matter who you are, there's a negative pressure that we've seen evidence in share prices. So for bottom dollar reasons and ability to raise in the capital markets, folks are having to get honest with themselves about what their plan is. And a word on that, Maggie Peloso, who's not on the panel with us today, does a lot of work on ESG and advising companies, both public and private, to their client goals. And, has talked a lot about the change just in the last 18 months between this is our carbon goal, we're going to get to X% by 2030, and that just not being good enough for folks anymore. You have to show a real and demonstrable plan in terms of how you're going to get to that carbon neutrality. And you can't just say, well, we're going to invest in wind and solar, and we're going to look at emerging assets and put money behind that. It's got to be more specific, which certainly the SEC rules back up. Can we go to the next slide, please? So mentioned kind of the goals are focused on decarbonization. Well, how do we get there? As someone who, as I joked, maybe not so successful at the front end, has spent most of their career in renewables. I've certainly been on panels with oil and gas folks where they kind of take aim at you, thinking that you are some high-minded idealist that just thinks that we can have a fully electrified grid if we just, maybe change a couple of policies. That's not practical. The energy mix is really an energy mix. It relies on using the resources we have responsibly and sustainably. So many of my colleagues forced me to eat my words around carbon sequestration in terms of how relevant that's going to be to getting this done. There are certainly plenty of assets that have otherwise economic life left in them that are important to a stable grid. Wind and solar, as much as we might like to think otherwise, are variable assets. Solar, notwithstanding being less variable by virtue of the production installation during the day, still has the duck curve, still has issues with when it can be deployed, which are not entirely solved at this stage by just tacking a battery on. So you need to look at how we get there on the full footprint, which is not just a generation question, but emission reduction in terms of electrifying vehicles, energy efficiency. I got tapped to speak on a panel about a decade ago between the Department of Energy and the Russian Ministry of Defense. And other than being way out of my league in terms of who I was up on the stage with, the one thing I remember is I was the only US person speaking and the only one focused on generation. Europe, Russia, by and large, were focused on using what they produce more efficiently, how that can lead to economic investment, and something that certainly there's a lot of folks kind of sharpening their pencils on here again, because this country does not have the best track record on figuring out how to spur investment in energy efficiency. Waste reduction, Certainly another place we see a lot of opportunity, how we manage our waste and recycle it, reutilize it. And by that, I don't mean the blue or purple trash cans out in front of your house. I mean what happens afterwards, and how folks are actually dealing with some of the more contaminating equipment in terms of real technical and chemical solutions to breaking that down. And then carbon sequestration continues to be the place where Danielle and I personally spend a lot of time focused on talking on what it will take to open up that market. Speaking frankly, in the terms of something near and dear to your hearts, which is capacity, specifically ITC capacity. You know, I spent a fair amount of time telling folks looking at carbon sequestration that by and large, the bank capacity is spoken for by solar without a change direct pay or something of that nature. But that doesn't change the fact that deals will get done. There's a couple of deals that have been announced. They're going to be harder to do, and a lot of different people kind of pulling at where they can add value to the chain or participate, I should say, in the sequestration project. But certainly something that if we're going to maintain a stable grid is worth the time and effort. Go to the next slide, please. Danielle, do you want to pick up on maybe some of the technologies here that we're looking at?
Yeah, so I think just to echo off what you've been saying, I liked your words. It's really the full footprint that we're looking at here, and there's a full solution. And we're definitely seeing the shift from private capital to looking at all the different pieces of the puzzle that'll be required for a full energy transition. Again, it won't be a light switch. I don't think oil and gas are necessarily going anywhere, but to some of Michael's points, there can be, more efficient ways to use fossil fuels. There can be carbon mitigation strategies to offset the impacts of fossil fuels. A very advanced Google search will tell me that there are some 6,000 products that are made from traditional fossil fuels. If we're talking about, replacing natural gas, which may be a different debate, but if you're looking at electricity from wind and solar generation, that's one of the 6,000 products. So there's a whole larger industry and a whole larger set of challenges to be looked at and achieved. And so we're seeing, private capital looking to put their money in all those different places. We're going to talk more about maybe some grid flexibility, grid resiliency, transmission lines. I think there are a couple elephants in the room that everyone will need to focus on and find solutions, because it'll be a bit of a chicken and egg problem with a few different types of investments, but we'll hit on that more later. But as you can see, there's a wide variety of places where money can be deployed. That's part of the entire mix for the energy transition solution. Next slide. Not at all to downplay the role that wind and solar power generation will continue to play. And again, I think it'll sort of be a catalyst as there'll be one movement on sort of the carbon mitigation strategy. If we're going with the electrifying everything movement, the more that we develop charging vehicles and charging infrastructure and other assets and technology that use more electricity, that's only going to continue to grow the demand for wind and solar power generation. So here's just a slide showing some of the estimates of what that growth needs will look like in the coming years. We can go to the next.
If you guys think you're not sleeping now, just wait till 2025.
Yeah, and kind of a similar trajectory, for example, for hybrid or electric vehicles. All right, let's go to slide 14. Michael, if you want to hit on that one. Here's one of the elephants in the room, right?
Yeah, so I'm sure that many of you in the room have heard this before, that that green energy isn't necessarily all green. There are component pieces that go into that. Those components are generally raw materials that need to be mined. And this slide does a good job of just showing kind of a lot of the different resources that go into conventional versus electric cars, and then the various generating technologies. And to the extent we're going to be ramping up production as necessary to meet those ESG goals. If you just think of the wind and solar chart, just the solar component of the chart that Danielle had up a couple of minutes ago, that's going to need increased mining capability in terms of both efficiency, cost, transport. There's a whole network that goes into a supply chain that goes into supporting, which we've been reminded of all too well the last couple of years in terms of the challenges in supply chain disruption. And so this slide does a good job of reminding us all that the transition is not without other costs and other elements, and that there are opportunities there. Specifically, when we think about private equity, just we've alluded to it a couple of times in terms of the return profile. Those folks are certainly playing in a meaningful way in both utility scale and CNI solar. But if they're looking at how to balance the funds in terms of deploying the large sums, they're looking at ancillary services and ancillary markets and sectors, and mining would certainly be one of those where there's more renewed focus. Attendant to ESG, you might think, how is mining ESG? Well, again, the components of the modules, the batteries, et cetera, have to come from somewhere. We go to the next slide, please. And so I left this slide up here, not just to frustrate all of us who have been waiting for this, but to note that there's been a lot of kind of value placed in some pending changes. I recall when I first started doing renewable work in 03 and 04, the PTC was set to expire. I've lost track of how many times it's expired and how many times we've done kind of safe harbor extensions and the like. But noting that the government does have obviously a role, I know many of you and much of the focus of this group is on lobbying efforts to extend the ITC, PTC, to the extent that we are successful in an ITC extension, particularly without direct pay. You question really what other technologies get off the ground, specifically, as I alluded to, sequestration. I don't see a lot of banks lining up to do sequestration when all you IPPs out there have the solar deals that they know and love with a reputable off-taker, more bankable transaction. But if we are to get to carbon neutrality, as we keep trying to stress here, hopefully in an inoffensive way to this body, you are going to need to work beyond just solar and wind. So I won't spend too much time on the wish list here, but suffice to say that we all remain hopeful that Senator Manchin and others will find their way, presumably not before the election cycle here, unfortunately, but I know that you all will be tireless in your efforts to keep pushing regardless of the practical impediments that stand before us. If you go to the next slide, please.
Just to jump in, I mean, I will add, as far as just the administrative support or rules that we have or don't have, in my experience, it's really uncertainty and changes of regimes, upcoming expirations of tax credits that sort of put a pause on deal making and transactions. Similar in the oil and gas space, commodity fluctuations. Oftentimes, deals can be done if there is certainty. And it's really whether it's good or bad, right? At least the rules that you're playing by, versus there's normally a pause when there's uncertainty. I think the key here is, though, obviously we're hoping for more to come out of the administration, clearer rules, direct pay, different avenues that can help the transition. It is a full catalyst in a transition that has started. And I've seen a lot of deal making moving forward. We might draft provisions that say this is what happens if direct pay were to be enacted, but it's not holding up the deal getting done altogether. So I think that's very, very positive for the energy transition. All right. We can move to the next slide. And the next, let's start talking about who are the actual players in the private capital space. Again, that's sort of the focus of this presentation. Obviously, one of the key players are going to be the private equity funds. There has been a massive amount of capital that has been raised and invested in the past, really 10 years in the renewable space, and it's constantly growing. You can probably see a new article every week on new funds being raised, new rounds of funding. And you'll even see that there are a variety of private equity funds that might have different funds that are available, whether it's renewables focused, energy transition focused, infrastructure focused, ESG focused, that could probably play, all could play in the energy transition space, one or the other, depending on sort of the needs and goals of that fund, or ability to combine in certain investments coming from the same asset manager, fund manager on different types of transactions. As we've been alluding to, there's obviously some challenges for different private equity funds in investing in sort of the traditional wind and solar power generation space, whether it's the return profile, for example, having foreign investors that need to be blocked, and that impacts the return that they get. So different hurdles that we have seen, although I think they are quickly, they are definitely looking at ways to diversify the portfolio. And if it makes sense to invest in a singular, wind or solar power generation facility or a larger IPP to have a, better fit their return profile, they're certainly working to do that. Let's go to the next slide. Let's talk about venture capital. Venture capital money is definitely being put to work in this space as well, particularly in the emerging technologies, clean technologies, sort of early stage funding. There's been a lot of growth there. This sort of fits into all the other stuff that we've been talking about in energy transition, for whether it's alternative fuels, biofuels, kind of all the replacements for fossil fuels that we'll have to come up with. One trend that I think you'll see is, you may see, and we've seen some examples of sort of non-venture capital companies playing a role as a venture capitalist for some of these new technologies. And an example would be, take a company that is a large energy consumer or has a large carbon footprint and wants to invest in technology that it can use, perhaps personally, to offset its own carbon footprint. So you're kind of seeing these larger, not a VC firm, but investing, VC style, whether it's pilot projects, kind of new emerging technologies to play that role and get a foot up in how they can offset their own carbon footprint.
Yeah, and just a word on the traditional venture capital players in the renewable or energy transition space. 10 years or so ago, a lot of folks in the venture space got burned trying to get into clean tech. In fact, clean tech was a dirty word in Silicon Valley for quite some time. And a lot of that consternation had to do with just the distinctions between where venture capital usually plays and energy, which has a kind of longer life cycle to an exit strategy or a clear exit strategy. Put another way, you can invest in kind of drug companies and other things and have a 3 to 5 year cycle. Energy transition, not necessarily the same. So the venture capitalists have learned from it, but aren't so burned that they're not going back in. Where they tend to go back in, though, is on technology solutions, software solutions, things where they can see a little bit more line of sight. We don't see VCs investing in generation per se at all. It's more heavily on the software side, I would say.
Go to the next slide. Institutional investors are also a key player. I think you can expect they're always going to take a more balanced approach across their portfolios, but it's very much becoming the case that many are sort of mandating and incorporating that climate risk, ESG concerns need to be a part of their well-balanced portfolio. Similarly, sovereign wealth. Oh, go ahead.
Oh no, I think just ping, but I was going to borrow Cam's line that you see these folks heavily in the M&A space, where if any of you tried to sell a company or tried to buy a platform recently, the number of competing bids have skyrocketed because you have all these folks, particularly Canadian pensions and the like, coming in, sovereign wealth, making credible builds, looking to build out their ESG aims. So whereas you might have had 3 or 4 credible bidders previously in your price range, that number, you probably have 25 at the outset and a short list of maybe 10. So just a lot more competition for the assets by virtue of a lot of the folks on this slide coming in.
And it's something we don't really see much in the US, but you would see outside the US is the emergence of sovereign wealth funds investing in the energy transition space. They're definitely, I don't think you'd expect a sovereign wealth fund to really be an early adopter of some of the newer and emerging technologies. But you can certainly bet that if there is a piece of the chain, of the value chain on which a particular country has, for example, either an abundant need or has an abundant resource, that you'll see sovereign wealth funds investing in that area in particular. We can go to the next slide. Like, you want to talk about oil and gas companies?
Certainly. So here at V&E, obviously we work with a lot of oil and gas companies. And frankly, when I looked to move over a little over a year ago, I was concerned with kind of how that fit with the work that I do every day with you all. And we see oil and gas not necessarily trying to come in and take over the generation side of the equation, but we see those folks more kind of in offtake deals currently, around RNG, hydrogen, some of the other components that they understand, pipelines and the like, in ways that maybe some of us don't. So that their energy and focus has tended to be not necessarily in wind and solar generation. I've seen a lot of the majors coming on hedge and offtake contracts where they're kind of smart on trading load, but otherwise a heavy investment in biofuels, RNG, hydrogen, sequestration, And that's not to say that they're not playing in renewables at all, but just they're pragmatic about the fact that where they're likely to be competitive and kind of move the dial meaningfully is more on the fuel side than it is on the electric generation side. You go to the next slide, please. All right, so what does this mean in terms of the investment trends? Back one. There, it's like I'm driving. All right, so we've hit on this theme several times. The opportunity has attracted capital from a wide range of folks. It's driven down yields on mature assets. You know, we've seen a lot of value in pipelines. I can think specifically of a company that was taken to market 2019, valued based almost solely on their operating assets on a discounted cash flow basis with, you know, a slight premium to the pipeline. That has changed drastically in the 2 years since. By and large, we've seen pipelines not get necessarily the lion's share of evaluation on a mature operating platform, but certainly be the exciting piece of a puzzle and where the distinctions in valuation lie, which is to say where competing bidders distinguish themselves, not just in the dollars that they're attributing to that pipeline, but in how they're going to work to build out the platform itself. You know, a lot of these, you have in any given platform company investors and folks that have been working those companies day in and day out. And in some cases they overlap, but they're not all the same. And a lot of people have put blood, sweat, and tears in these companies. They want to know that they're going to be able to work with a capital provider that's going to see their vision through and not be a pure cold bean counting exercise. So we've seen deals get awarded around the margins on price to folks that kind of seem like their heart's really in working with the platform to expand it. You know, I thinking of a not a solar company, but another one where I had a client, you know, doing a competing bid where they were looking to purchase a platform, kind of get in on a lower valuation, and competing with someone to do a project financing at just a set return. And part of what made it attractive to the platform company was that they came in and said, look, here's the number of dollars we're willing to put behind you, but specifically on this project, let's not talk about like getting it to pencil from the most simplistic, but how we can make this the most optimized project and lead that out as the linchpin for this operating platform that we plan to build behind it. Again, so getting traction on a vision. And I know that sounds squishy, but it is when there's so much money coming into the space and there's so much competition, how you distinguish yourself can come in all different ways. And that's one that I kind of saw play out specifically. Strategics and financials, no secret, have a lot of different approaches to how they come at things, why they might be interested in investing. But the common push is to purchase things earlier if you're looking at just the asset acquisition and off the platform acquisition. Which is to say, years ago, you could pick off a project, have a development service arrangement with the seller where a lot of their compensation is back-ended depending on cost overruns and completion. Much harder, if not impossible, to get that deal done. Developers are kind of extracting the development premium on the front end of the deal and often pushing the risk back. The paradigm has shifted heavily. And in order, you could still get a deal done, you know, at NTP, but your margin's going to be entirely compressed if that's kind of fundamental to your investment profile. And then, as we've alluded to, some investors are focusing on ancillary infrastructure versus core generation. We talk about it in terms of operating software as a solution, particularly with battery integration. Ancillary infrastructure, the one that, you know, Danielle and I often speak of, and we'd like to think we will get some traction is transmission. We can build all the generation you want. If you can't move the power efficiently, we all know about the challenges of eminent domain, landowners, and how you site this stuff. So not suggesting that's going away overnight, but we clearly, as an industry, need to put our heads together and push on transmission just as much as the individual generating asset classes if we expect to be successful in a lower carbon footprint. But kind of, I think that's going to push us off the slides and talk a little bit more about kind of some of the specific examples in terms of what we've seen working with our client base energy transition assets. And Danielle, the first one I wanted to highlight was we have one investor we work quite closely with that has 4 different pools of capital that they can pull from, 4 funds, think of them, all with different risk appetites, hurdles for return. And they're looking very targeted at how they use that mix of capital to be more competitive. This investor has kind of made some bids and hasn't gotten traction on them. And so they kind of redoubling their efforts to look at, well, where can I maybe, should I be focusing on platform plays? You know, while I have a fund that objectively looks like it fits that, I'm not necessarily interested in certain markets, maybe call them ERCOT, and I have cost of capital that's competitive, but has a band in it that maybe makes it tighter. Should I be eschewing the idea of platforms and looking more at development capital, where the tension there has historically been, you could probably get the returns you're looking for, but the time it takes to do so and the check sizes of the individual investments gets tougher. There's just not enough juice in the investment. So looking at how they can do programmatic development financing, maybe with some of those same platforms that they weren't as attractive to as a long-term owner and capital provider. So kind of thinking about how the PE shops look at, you know, the arrows in their quiver and how they might deploy them across the sector to get involved in deals where they can win bids and then meaningfully invest their dollars.
Yeah, I guess just to echo off that a little bit. I mean, I think I have on more than one occasion heard some of our different private equity clients that they could just describe, you know, what's the white whale that they're looking for, right? Particularly in the wind or solar power generation space. And some of the common themes that I hear them say would be either you have your existing operating assets, but the real value is in the development projects. And as Michael was saying, we're really seeing prices being, you know, driven up because there is a lot of competition for this capital. There's a lot of people that want to be in this place. When you find some of these bigger, you know, developer and operating companies, you know, that is kind of the white whale that they're looking for. The kind of dichotomy that we hear from clients is at the end of the day, the projects do need to underwrite the price, the check that they're going to pay. And when these auction processes, we see some very big checks being written. So the individual projects need to be able to, you know, underwrite that price, but there is a lot of emphasis put on the development side and the growth that you can see there. You know, another example of kind of the white whale that they're looking for is if you have an existing developer today who's obviously going to have, you know, lumpy cash flows as they develop and sell assets, and there's a long pipeline, is if you can find that developer, find that management team that is willing to grow into a developer and owner operator, keep the assets or, you know, partially monetize the assets that they're developing, and eventually, you know, having that cash flow from the operating assets to be able to fund sort of the ongoing, you know, development of the pipeline assets. And, you know, that's when our clients really get into sort of Michael's alluding to. These auction processes are very competitive. They obviously serve a really important role just in the M&A process, but, you know, the bilateral process, finding the right match and marriage between a management team and capital provider, I think is what at least, you know, many of our clients would say that they're really looking for, because you've got to have the right strategy. And yes, the underlying projects have to, you know, underwrite the check, but you are really, you're underwriting that developer and that management team that you're partnering up with, you know, at the end of the day. And again, that's not really something that can always be, you know, added up on paper or on an Excel spreadsheet.
And I think part of when you're backing a platform, we've also seen the need to be flexible, right? You have your investment thesis. In fact, I think of one example where I started working with a fund who was looking to deploy off the fund balance sheet, kind of a captive team. And their thesis was C&I solar. And they were going to do C&I solar. They're going to bring standardization, kind of look for a more efficient deal. I spent a lot of time dreaming about being able to securitize C&I solar assets, have a standardized form contract. They were focused on the same thing. We come to find out, as we've seen so many times before, that it's easier said than done, or maybe it's not even easily said. But because of the competition in the sales channel, you're not getting standardized contracts. The Walmarts, Amazons, et cetera, the world are going to impose their contracts, which, while financeable, are varied and don't lend themselves to an efficient transaction. So what that group has done is pivoted to more utility scale. Now, utility scale returns are lower, as we've mentioned, but that you can get more bang for your buck in terms of dollars out the door and need to deploy that capital. So you might need to be flexible in terms of how you think about what's out there. I mean, you can't, not everything is for sale. You have to work with what's available and work with the teams you have, and that might involve kind of retooling or rethinking. Another area where Danielle and I actually spend a lot of time with private equity folks, in particular in platform post-acquisition or as they're making bids, is the need for credit support. Private equities, they have committed capital. They don't necessarily have a lot of cash on hand that's undrawn. And as the folks in this room, I presume, know, the ticket to entry for a tax equity deal is a guarantee from a creditworthy entity backstopping the ITC. We can all quibble about why that's still needed and what the size of that should be, but that is, for better or worse, the market. And so how do you get there with the private equity shop? You can put up the balance sheet of the operating platform, which is presumably minimal, depending on what you purchased. We've seen reps and warranties insurance, tried and true in the M&A market, start to creep into project finance deals where balance sheets maybe weren't there to support the claims. Obviously, there's been a lot of development in the ITC policies over the years where those shifted from something that people like me looked at and said, yeah, maybe you can collect on this in the perfect circumstance if the sponsor didn't breach 10 reps to the insurer. Now the insurers truly are underwriting ITC and including casualty risk. So that kind of opens the door where you can see how a blended product with maybe reps and warranties and ITC insurance, a platform guarantee, and some diligence and or nominal support from the private equity sponsor in terms of backstopping all that gets you back to a deal that could be done. But the point I'm trying to make is it's not easy. And I've had more than one conversation with folks just frustrated as to why they need to post such a large guarantee. And well, wait a minute, I'm not marking up my system. I'm doing at cost. And why is my ITC going to be challenged? And what I say to them is because of the competition. You're competing for capacity. If you're doing CNI, many of you folks know that, again, those deals just take more effort per megawatt to invest in. If I'm a big bank and I can put $200 million behind an IPP that I've done 5 other deals with and get a set return versus maybe a slightly better return with your CNI shop, but no guarantee, that's harder to get through credit, regardless of whether or not I want to do it. So just being pragmatic about kind of the barriers to entry and how we might solve for that, and kind of having an open dialogue as to why that expectation exists. The fact that you're not going to be able to completely override it, how you might kind of fit what you do have in your quiver into the boundaries of what's needed.
Maybe shifting gears a little bit, talk about some other trends that we see. I think we've alluded to is that is for private investors to be looking at if wind or solar power generation doesn't quite fit their profile or isn't the full where they're going to deploy all of their capital. It's really the services companies, the ancillary services that are needed in this space, and what I sort of call the renewable adjacent. If you think about, yes, we need the solar power generation companies, but what are all the other pieces of the puzzles that we need, or of the puzzle that we need? And so if you think about it, there's obviously transportation pieces that are needed in this industry. Lay down yards, storage yards. Think about offshore wind. Think about the vessels that'll be needed, the transportation logistics. Sorry, it looks like I got muted there for a second. Logistics, the transportations that you need on the ground, that you'll need, offshore, hauling these huge pieces of equipment. We need the O&M companies, the operators and maintenance companies. We need asset management companies. We've talked about the software, the technology, battery storage. There are tons of other pieces of the puzzle that all are, part of the energy transition or even part of a successful, solar facility. And we see clients looking to sort of expand and be part of that piece of the puzzle. The other sort of related kind of renewables adjacent is we see a lot of creative financing arrangements that folks are coming up with where they can put their money to play wherever the money is needed the most. And I think one of the key financing solutions that really is needed is for developers early stage. You see that in platform acquisitions. The reason there's sort of a stress for the money, like Michael was saying, to be paid earlier in advance, developers getting the money earlier in advance. we've seen folks come up with specific solutions that really provide, a unique financing opportunity to developers as they meet different criteria and goals to kind of help give them a more balanced, access to capital when, again, their cash flow is going to be sort of lumpy. I, for example, in the past year and a half, worked on 2 different transactions that were called renewable royalties. And before I started working on the first one of my partners called me up and said, "Hey, Danielle, do you know what a renewable royalty is?" And I don't know, this was probably, like I said, maybe a year and a half, 2 years ago. And I said, that's not really a thing, but I'm happy to talk about whatever people think that it is. And coincidentally, within about a 12-month time frame, I worked on 2 different transactions, both couched themselves of renewable royalties. They were completely different structures, features, nothing like an oil and gas royalty where we all know what that is. One was providing solutions to developer financing needs, and the other was really a land play. So there's all kinds of creative ways that people are putting their money to work. Really, they'll find a problem in the energy industry that's needed and find a method that fits their funding criteria and then come up with that solution. Michael, you're muted.
I remember the first time I saw one of those renewable royalty deals in a development acquisition, I wondered who the hell did what. Frankly, I was trying to figure out, but if you think about it, it's a modeling exercise at the end of the day. There's certainly more juice in there for, a private equity shop in terms of a longer term royalty than just a quick flip on maybe a lower dollar number. And it's not unlike, your land lessor where you're paying a percentage. So it's a percentage off the top. It was a little funky to get used to, but we've seen that kind of flow through more. The other thing that we've seen a fair amount of in terms of folks kind of recognizing that maybe the platform plays, the barriers to entry there are more difficult is standing up management teams with kind of sweat equity hunting licenses. Certainly something that Danielle and my colleagues have seen a lot in the oil and gas space, but looks a little different in energy transition. And by that, I mean, we've had folks from various private equity shops saying, "Hey, got a new transition fund. I've done this in oil and gas, right? Back the team that brings me projects and kind of maybe cover G&A to some degree within a budget, but I have control." And the question of control is one that's not as necessarily assumed in this space. And that's largely because of the opportunity. So I've been working with a company that is kind of looking for suitors effectively to provide 100% capital financing for various assets that they're chasing. And again, this would be atypical for a lot of the private equity shops, but one of the guys actually came to me and said, "Hey, I want to talk to you about this, but just at the start of the conversation, I understand that unlike what I'm used to, if I'm looking to back a team in energy transition, what that control feature that's been so sacrosanct before is not necessarily going to be as straightforward, that they're going to want kind of, and for me to get someone worth getting, I'm going to have to give up kind of more control in the day-to-day, albeit subject to any dollars going out the door being subject to my approval, but give them a little bit more leash." So in terms of those that are kind of looking to maybe branch out there, that's something that is hard to get documented and agreed, but certainly a viable option for folks, just again, because of the opportunity for the competition. I wouldn't say you could write your own ticket, but folks aren't afraid to ask for what makes it worthwhile to them if they've got the experience to actually deliver.
Maybe another trend to talk about, although I saw more of it last year and interested to see what you've seen, Michael. But more last year than this year, a trend towards microgrid, sort of going the opposite way. We've talked a lot about very large scale projects, large scale investments. There's tons of money to be put to work. I think on the microgrid situation, it's obviously smaller scale. You have to find the right opportunity, but in some ways, maybe easier to deploy over and over once you sort of get your process down. Definitely saw more of these last year, not as many so much, at least me personally, this year. I think similarly though, we get lots of inbound requests around co-location of assets. Any assets that can work together or serve each other together, putting your solar farm right next to the end user. And the most fascinating one that I've had more calls on than I would ever expected is co-location of a solar farm with your Bitcoin mining operations so that we can power Bitcoin mining, not put a stress on the transmission lines on the grid that we've alluded to that we already have, And if you're a landowner who has an opportunity to place both a solar farm and Bitcoin mining operations, there is a lot of money for you to be made there. And we'd love to talk to you about that one, but that's the fun one that I think I've got more calls on that than I would have expected.
Yeah, the microgrids I think are very much alive still. And there's a couple of platforms that we're working with on those. Unfortunately, I think they've been hit harder by the supply chain issues just because their orders tend to be lower than the kind of IPPs and bigger players. So I'm thinking of one platform in particular that had, I think, a good chunk, let's call it 50 megawatts slated for 2022, of which most of it has been pushed just by virtue of supply chain kind of concerns through COVID and getting the site host agreement signed up. So something that folks are still very active on. I expect to see a ton of activity in, but stalled a little bit, maybe more heavily impacted by recent world events. So I think in the last 10 minutes, we are going to try to get to some of these questions here on the side. So we've been receiving, let me just go through here. I got one on the anti-dumping investigation and what impacts we're expecting or anticipating there. A lot of drag, which is to say, the laws were on the books. This is not a new law that's changed. The retroactive nature of enforcement certainly has people spooked. But I think it's really different depending on the nature of the sponsor of the transaction, which is to say that folks should have already been tracking where their panels were produced. Again, I know that this forum has had a lot of focus on this, so a lot of this probably isn't news to you all, but now we have an enforcement proceeding and there's a lot of noise in here, but frankly, a lot of the contracts that we did in the last 18 months kind of had specific call outs for compliance with these laws. Generally, it was probably picked up in your general reps and indemnities around compliance with laws. What it means if you have a 100% hit on the cost of your panels in practice, though, is a very real thing. And we'll certainly, when we see one of those, we'll again grind things down. But in the meantime, I would expect better heeled sponsors to be able to cover off the risk with explaining how they know where their panels have sourced, how they put this risk back to their suppliers who are responsible and have the credit to back it up. And which is to say, financing partners will effectively look to push the risk like they often do. And as long as you have can kind of answer the questions other than asking them to fund into a blind indemnity, which no one's interested in, I do think the projects can go forward. When we have seen shift in supply, working with a platform that was looking to sign up a large module supply agreement and shifted course about a year ago, right after AD came down, and went with a more expensive supplier to avoid issues like this, kind of seeing it. So again, this is now an enforcement of an already existing law. People should have been tracking that law. I know that there's temptations, but I would say it's mostly drag and noise at this point, pending an actual enforcement action being publicized.
There's another question here on the developer financing side, hearing more about early stage financing. Do you see any other ways other than a renewable royalty, like credit facility with the banks? Oftentimes on some of the developers that our clients will come in and be looking to acquire, there may be a situation where the developers sort of gotten kind of a piecemeal different methods of early stage financing. And again, maybe that's selling off a portfolio of projects or sort of a subset of them. Maybe they have an exclusive area with someone where anything that they develop, that person has a first right or a first obligation if it meets that criteria. So early stage, if there's any way that you can get someone locked into a funding commitment for certain types of projects. On the debt side, I think that's probably the harder one to solve for a true developer. If that's really your only set of assets, again, lumpy cash flow situations or issues. I think someone maybe other than a traditional bank, we have seen some who are willing to dip their toes into that space, come up with some creative solutions. So it exists, but not kind of your normal credit facility.
Yeah, I would agree. I mean, look at the question, says like credit facility with banks, not with banks, with direct lenders. You could do it. It's a question of kind of what other collateral or what other opportunities are attached to it. Maybe an investment in the platform itself. But direct lending is available for that stuff. It looks as different as you can imagine, depending on who you're talking to. So I can't tell you there's a formula for it, but certainly a lot of the PE money that we talk to is looking at that space, putting in, fixed return, pref capital, debt, whatever you want, again, different flavors, because they can make the returns that they're looking for there, but they're going to need to get in your shorts to understand the asset and the repayment. So we tilt back towards some sort of equity play when we look at the availability of that financing.
The ones that I've seen have been quite complicated and aggressive, more from the lender side.
Mm-hmm. Have a question here on yield compression in the capital stack, and calls out tax equity, debt, and common. Debt has been compressed for quite some time. Still shocks me what back leverage goes off at for deals in terms of just over LIBOR and now over SOFR. So I don't think that there's much more room to compress those folks. Tax equity continues to have the capacity constraint, so it hasn't moved that much recently. In the utility scale space, you haven't seen more than 25, 50 basis point spread between banks for quite some time on kind of big IVP deals. On C&I, yeah, that's where it can spread more rapidly. And again, because capacity is king, there we're not seeing as much yield compression per se, but it's still not at the rates it was, or the higher rates it was in the aughts. So still think 6s, 7s there. And then the common is something has to give. The common is where it gets squeezed, right? So effectively, when did you buy in? What development fee did you pay? Your kind of costs are sunk, and you're going to be holding the bag on cost overruns, indemnities, the like. So that's where the compression is really hit, and what makes the acquisition process so interesting, for lack of a better word. Just kind of how you're modeling out. I've seen assumptions as to here's how I get to X or Y return, and I say, okay, well, as a C&I platform, you just penciled in 6% for your ITC capacity. Unless you know the bank that's giving that to you now, I'd ratchet that number up, 100 bips, and you still might have trouble placing it. So everything kind of comes to drive off there. And I think people, when they're making bids, need to be more realistic in terms of the availability, specifically where it's going to be sourced from for their type of assets, and relationships you might bring to bear to get the attention of these folks who have crowded calendars and busy phone lines. So how do we see lenders financing for resi companies? Frankly, I haven't done as much in resi recently. I did a bunch of that stuff at my last firm with the kind of household names that you've all seen. There it tends to look much more like a commoditized product. So direct lending, solar loans, we've seen, the solar mosaics of the world have kind of had their say, which is to say it's available, but how do you see resi ramping up? I don't know about the penetration rate, not putting those companies down, but it's still a door-to-door business largely in terms of how you're placing it. So while we will continue to see more resi deployment, I don't expect it to shoot up rapidly. And for that reason, I think the folks that are in those markets will stay in those markets. But you won't see kind of a massive influx of capital beyond PE folks looking to maybe buy platform plays or look to do the sourcing or the own the installers. We've certainly seen investment there. In terms of debt, I just don't know that it's terribly exciting. Where I do think that there's kind of more juice or more focus is against C&I. You just have a lower permutation. As difficult as it is to do, there's a lot of opportunity there, particularly if you have, through your other relationships, a captive audience with a bakery brand or motel chain that you can deploy into. So apologies, don't have a lot of kind of deeper analysis there for you on kind of how we see debt in resi markets. I think we've come to the end of our hour here. So I'd like to thank folks for submitting questions. Danielle and I always fear that we'll just be talking heads broadcasting, and wish we could be in the room with all of you doing this in real time. Maybe someday we'll be back to that. But thanks again for your interest in attendance here today and all your efforts through SEIA.
Thanks, everyone.
This now concludes our webinar. A reminder that SEIA members can expect to receive a copy of the recording and link to today's presentation and a follow-up email next week. Non-SEIA members will receive the presentation and a follow-up email shortly after. If you're interested in learning more about SEIA, please reach out to membership@seia.org. Thanks for coming, everyone.
Thanks.